for dollar-based investors.
You told me yesterday you went from a maximum long on long-term treasuries, that you cut that back a little bit in recent weeks.
Yes.
What do you do from here then?
Well, rates are kind of stabilizing. They're at a not so attractive level anymore. When you could get 5% and you thought the inflation rate was going down to even 3%, they were awfully attractive. But now we're at 3.5% in lots of parts of the market. We've been favoring not so much trying to be long at the long end of the market, which had been good for part of the year, but rather the relationship between short rates and long rates, which has changed from 2s, 10s by 115-plus basis points since we were at the maximum inversion. I think that's going to continue. I think we're going to get the two-year Treasury rate to go down to about 150 basis points less than the long bond. So there's still a long way to go. And so that's sort of a trade. So what we're doing is it's odd. You're actually taking a more positive position on 2 years, 3 years, perhaps even 5-year Treasuries, and a less optimistic view of the long end. So it's really weird that you can actually shorten your duration and actually benefit from rallies. That's kind of weird. And that's because it's the short intermediate end that's rallying. And I don't think the long end's going to rally much anymore. I think that the easy money's been made on the long bond.
You've also, you've talked repeatedly about the deficit. This idea that you would think, because we're embarking on this cutting cycle, that yields all across the curve would continue to come down. You suggest that could happen, but then on the longer end, certainly you could have interest rates actually go up as the cost of funding the deficit increases.
Yes. Well, long-term interest rates on the 30-year Treasury, they've barely changed year to date. There's been volatility, but they haven't gone down, while the 2-year Treasury rate has come down a fair amount. And so this steepening theme and the rejection of recession being a positive for the long bond has been in play all year on a point-to-point basis. So I think that the problem that I worry about is that our responses to recessions have been incrementally more money printing. Yes, COVID is very unusual. We hope we don't have a repeat of something like that. But the amount of money that they were willing to give away is a cautionary tale as to what might happen when the next recession comes. And that's my thesis as to why long rates might actually, after the initial Pavlovian response of coming down, which has already happened to a not insignificant extent, that may get rejected and rates may start to go up. And that would be a real trap. I mean, you could even have like a failed auction or something. Remember when that happened in the UK and the long bonds went up 100-odd basis points in a day. I think we have a chance of that happening if the policy isn't handled correctly. But it's going to be fascinating to navigate through this because none of us know what it's like to have a big bear market in bonds, start from a level, and then will they drop during the recession? Maybe they won't. Where will credit spreads go during recession if, say, junkier borrowers don't have the ability to refinance during recession, which they've had historically because rates go down? Even though spreads widen during recessions, the base rate, the Treasury rate, has always come down quite substantially. I'm of the mind that that might not happen this time. And so there could be a lot of companies that are trapped into fixed-rate debt. Thankfully, these CFOs are smart. They locked in very tight spreads and very low rates back in 2021, and they extended maturity. So thankfully, it's not an immediate problem. But it's kind of like the rent data or the shelter data in the CPI. It's sort of like we see the new rent rolls are not that robust. There's actually parts of the country where the new tenant rents are declining. But it takes a while for the old rents to kind of get to their roll level and roll over. So I think we have potentially coming our way in 2025 sort of a tailwind on the shelter component coming down on the CPI. I think Jay Powell kind of alluded to that, too. He seemed quite aware of this differentiation between new tenant rents and rolling of old tenant rents. And it's happening at a rate that is that's shorter, a timeline that is more extended than most people, I think, are used to assuming when they look at the rent levels and the shelter component. So that's another reason why I think that the Fed is comfortable, much. He says he's balanced. Use that word over and over. What I heard was we're more worried about the employment picture than the inflation picture.
Oh, sure.
And I agree that he's right on that.
You've made the argument that you know, if people assume that it's going to be, as some have even suggested, that this is going to be a golden age for fixed income because of the trajectory of rates, that it's more nuanced than that. That you need to be more selective and careful than just thinking that way. How?
Yeah. I mean, the golden age for fixed income was a year ago, when spreads on high-yield bonds were 500 over and the base rate was at 5%. You could get 10% if you underwrote your credit risk prudently without really trying all that hard. But now fixed income rates are down around 3.5 on treasuries, for most of the curve. And we got these spreads that have widened, but they're still only at 320 basis points on junk bonds. So you've gone from 10 plus to 6 3/4, and the spreads have started to widen. And so I think credit is still fine in single A, triple B, strong double Bs, maybe even some strong single Bs. But you've got to be careful on where you are on the curve, and you want to make sure that you have companies that don't have rollover risk in the very near term.